Hey everyone, welcome back to the channel, your number one source for income-oriented investing. I am back with the main guys from Hamilton ETFs, Rob and Patrick. Guys, thanks so much for doing this on short notice. I literally just sent you guys an email. Hey, you want to do an informal quick video to discuss HYLD and HDIV's massive success and distribution increases? And you said, sure, no problem. So how's it going, guys?
Very well. Thanks for having us.
Yeah, thank you. Yeah, things are going very well. We've had some recent milestones. I feel like every time we're on with you, there's a new milestone. But we recently just surpassed 3 billion in covered call AUM. So
Wow.
we're very fortunate to be in that position, and that's just under 2 years. So we're quite happy with the growth. So that's making us now one of the largest providers of covered call ETFs, and also one of the fastest growing. So we're happy to be here with you and your audience.
That's fantastic. So speaking of milestones, let's talk about HYLD and HDIV because I feel like we're hitting new milestones very, very recently. So I'll just share my screen real quick here just so I could show the audience just in case want to see what we're talking about here. So HYLD, we'll do HYLD first. You guys should be able to share my to see my screen. Sorry. So the distributions have steadily been going up, and we're talking about two, and same thing for HDIV, by the way, two distribution increases 2 months in a row here. So the latest one, 14.3 cents a month. So we finally passed the ultimate or highest distribution rate, which was 14 cents a month back in 2022. And HDIV also on a tear, went up from 15.1 in March to 16.5. Now it's at 17.1 cents a share. This is monthly. So the obvious question, guys, is how were you able to justify the HYLD, both the HYLD and HDIV distribution increases, which of course many of my viewers are very, very pleased about?
Yeah, so I'll go first. So thanks for asking. A lot of this goes back to when we did the internalization, which we announced at the very end of January. So you may recall, Adrian, when we announced that, we identified three objectives. By the way, the internalization, for those who are not familiar with the fund or us, we sold all of our third-party holdings and replaced them with our own max ETFs on
Yeah,
a
that
sector
was in
basis.
February, right? Approximately.
Yeah, it was announced on January 29th, I think was the date. But yeah, it's essentially effective February. We had three objectives. The first one was we took the management fee to zero for HDIV and HYLD. Now, important caveats, people pay the management fees on the holdings of HDIV and HYLD, which are offered by us. So the management fee combined is not zero. The second thing we wanted to do is more closely correlate through our own management of the individual max sector ETFs, more closely correlated to the S&P 500 and the TSX 60. And the third thing we wanted to do, which is I think central to this conversation, was increase the yield. So that's sort of, it's not quite time zero, but that was sort of the inflection point. Now, you may recall in the past, we have talked about the distribution policy of HYLD and HDIV, and we've said that what we would like to do, or what guides us, is what is the yield of the underlying holdings multiplied by 1.25 to reflect the modest leverage. And then that's, that number is a number that we compare to the actual distribution of HDIV and HYLD, but we want there to be a cushion. We want the underlying times 1.25, we want that number to be higher, safely higher than the actual distribution yield of HDIV and HYLD. Going into the internalization, we had been building that cushion very gradually. So the difference had gone outside of our range. We generally think it should be between plus or minus 1% in order to sustain the distribution. Those for HDIV had actually got to about 2.6%. So that was a very, very large delta, or sorry, cushion, if you will. And for HYLD, excuse me, it was over 2. So heading into that, before we even did the internalization, we had been building cushions. So then we do the internalization, the underlying yield rises, and then we increase the distribution of HDIV by 7 and HYLD by 8%. But we still, yeah, by percent, exactly.
Yeah.
But we still had a fairly notable cushion, but we wanted to see how this would all play out. We wanted to see how the maxes did. So you may recall that in March, we actually did not increase, even though we had large cushions, which we didn't really talk about publicly, We didn't increase the distribution in March. So that cushion continued to be quite high. So in April, we increased the distribution in HYLD by 5%, and we increased the distribution in HDIV by 9%. But we still had a very healthy cushion. So this month, in May, we increased the distribution again, up by 3.6% each. We still have a cushion that's outside of our 1% band for HDIV and HYLD, so we have flexibility going forward. But this was really essentially the building of conservatism going into the internalization adding even more cushion, and then us increasing the distributions to bring that more in line with the underlying. And so we're pretty happy that we've been able to do that. The maxes, we are very happy with the performance of those that we put in. And so it's been good news all around.
Wow, that's incredible. So you're saying that even before the internalization, the cushion started going past your 1%.
Yeah, in fact, it was over 2%. The difference is in the yield. So the portfolio yield times 1.25 was more than 2% higher than the yield of HDIV and HYLD. Normally, we would think that cushion of 1% is good. And keep in mind, we don't keep this money, obviously. It's very NAV friendly in order to have a distribution times 1.25 that has a cushion over the underlying. So we had what we thought was a very conservative distribution policy. And so those cushions had gotten much, much larger, and that facilitated or enabled, I should say, a series of distribution increases. And what I would say is even today, we are still above that 1% cushion. So we do have flexibility going forward.
Wow, that's fantastic. So let me just translate it into layman's terms and just stop me if I make a mistake, if you don't mind.
Yep.
For my audience that's maybe a bit newer to these funds. So HYLD, HDIV, they're ETFs that hold other ETFs. And when we're talking about the internalization, in early February, that is when both HDIV and HYLD essentially got rid of all the third-party ETFs, so ETFs that are not under Hamilton's jurisdiction, and replaced them with all the new Hamilton Yield Maximizer ETFs. So it's basically an internalization of HYLD and HDIV, which is very, very positive because you're lowering your fees because you're not charging double fees. That's number one. I'm sure that helped. Now, am I good so far?
We weren't charging double fees. The third-party fees were getting paid to the third party.
Yeah, but now you're not.
So we were getting the top fees on the top side, and then other managers were getting fees on the bottom side. When we replaced them, we were able to take the management fee on the top funds, HDIV and HYLD, to zero, and the fees that everybody pays on a combined is on the underlying.
Yeah.
But I did neglect to mention though that taking the fee to zero on the top fund was also one of the ways that we pass on. It also helped the cushion, right? So
of course,
it also gave us flexibility to pass on that to unit holders in the form of a higher distribution.
Yeah, so like we could see now, if we look at what's inside HYLD, it's all other Hamilton Yield Maximizer ETFs.
That's right.
That is basically HYLD, you could say, has zero fee, but HYLD is paying the fees of these ETFs, which for the most part are all about 65 basis points, 0.65. Right. So that was where, that obviously that helped the cushion. So I just let's talk about what this cushion, what it is, right? So in case people don't know. So HYLD is basically a combination, and HDIV as well. Yeah. Other income-oriented ETFs from you guys now, all internalized, that, all Hamilton products. That's why we say internalize, or that's why what we meant by internalization. And that income that comes in, basically, because HYLD has 25% leverage, you guys are saying, okay, let's multiply that income 1.25 because there's 25% more income coming in. But we don't want to give out all the income HDIV and HYLD is coming in, is taking. We want to leave more or less a 1% cushion just to be safe. Now, what's happening with that 1% extra 1% cushion? It's not like you guys are just taking it or whatever. It's just staying within the net asset value. It's staying in the fund. And this is just a conservative way of distributing, because you always have a little bit of cushion that's holding back. So it's not friendly, you would say.
Yeah, so maybe just a different way of maybe to simplify.
Yeah.
If the yield of the underlying, they're They're paying up cash flows.
Yeah.
So if the weighted average yield of the bottom funds times 1.25 is, say, for the sake of discussion, 14%, then we want to make sure that the yield of HYLD or HDIV is at least 1% below that.
Right.
So that the cash flows that are going up into HDIV and HYLD, we're not paying them all out. We're holding some back.
Yeah. So HYLD is making a certain amount of money with a certain amount of income with all the ETFs inside of it. It's not, you're not paying out all the income HYLD is making, you're holding back a little bit, approximately 1%.
And it's helping support the NAV.
Yeah, exactly. Right. And NAV going up, of course, as well. That will help. So yeah, this is, you know, compared to other ETFs, which tend to just give out all the income, this is even a more conservative. It keeps the NAV and the share price more steady. So I know conservative investors really like that as well. So yeah, so that 1% cushion, you're saying that there's, even with the distribution increases recently of HDIV and HYLD, you still have that 1% or even more cushion right now.
Yeah, we have more than 1% for both.
That's fantastic.
Actually, I think it's, I don't have the exact numbers, but I think it's about 1.5 for both.
1.5. Okay, perfect. So, all right. So I'm going to say, I know you guys can say that is pretty much leaving the door open to further distribution increases, especially if it goes to 2%, 2.5%, et cetera. That would be my
let's
guess.
just say we have flexibility.
You have
the other thing to
flexibility.
add to Adrian is
Yeah.
we want HDIV and HYLD to have consistent distributions, right? We
Correct.
don't want them to have a lot of variability. So holding some back helps with that, you know, depending on how the markets go.
Yeah.
There's lots of dynamics.
Yeah, so for example, if volatility collapses or falls significantly and therefore the underlying maxes can't generate the same cash flows that they might otherwise had volatility not declined, you know, we would reduce their distributions modestly. As you see in the maxes, the distributions move up and down within a relatively narrow range, but it gives us flexibility if, for example, Nick decided, or Nick Picard, who is our chief option strategist, if volatility declined, his ability to generate premium income declined, we wanted to adjust the distributions of the underlying. This gives us, as Pat exactly noted, the flexibility to make sure that HDIV and HYLD can preserve their distribution.
Makes complete sense. And yeah, if we look at, for example, SMAX and QMAX, just as a quick example, these are actually very big positions in HYLD. QMAX is also in HDIV. If we look at QMAX, for example, which is technology, which has been on a tear, you guys have been steadily increasing the distribution. So this is, you know, like you said, the maxes, the individual stocks, the individual ETFs rather, they could have more fluctuation. You'll probably see more fluctuation with the distributions on a monthly basis. This is a perfect example where it's going up. Some of them, they could get reduced a little bit for whatever reason, volatility, NAV going down, etc. But for HDIV, HYLD, the fund of funds, we could expect much little variability with the distributions.
That's the goal. And it's the diversification that helps with that by having numerous strategies within it.
Exactly, because if you have some maxes that raise and some maxes that go down, well, it kind of balances out.
Right, that's right.
So that's just it's a benefit of diversification. Diversification just means more stability, no matter what. So pretty awesome stuff, guys. Really appreciate it. Hopefully, this is very clear to everyone. I mean, definitely some fan favorite funds here. And let's talk a little bit about the performance, because the performance has been nothing short of incredible. So this is HDIV here. Hopefully everyone could see this. It's pretty big. So this is actually from your Bloomberg terminal, I believe, which I wish I had. So HDIV here, you could see you're comparing it to the TSX 60, which is the index, you know, kind of like an S&P 500 of Canada. And you could see that it's outperforming, and you even have the data on your website as well. You have the chart where it's done really well. What is your comments, just if you have any, on HDIV in particular? Then we'll move on to HYLD. Why is it doing so well against the TSX 60? I know I have my assumptions.
Well, there's a lot to unpack there. Probably one of the biggest reasons is that you may recall when we first launched HDIV, the idea, and HYLD,
Yeah.
We wanted the sector mix to be broadly similar to this TSX 60, but we wanted to make sure that we did it in the best way possible. And in the tech sector, we were a bit uncomfortable with the size and quantum, or lack of breadth, if you will, of the Canadian technology sector. So we had US technology exposure. And so I think that's been a big variable. We've also had a very favorable, the stock selection, if you will, or the ETF selection underneath has actually also done very well. But I think, tech is a big part of it, being a bit underweight. Some of the areas that didn't do as well has also helped. But yeah, we've been really, really happy with the performance of HDIV, which has meaningful outperformance against the TSX 60.
Yeah, even if you go back from the beginning of HDIV, the outperformance is quite significant, but
I think we're about 7% ahead in total since inception.
correct.
Yeah. Yeah, it's very, very impressive. I mean, we are comparing it to the TSX 60. So now if we move on to HYLD, which I was extremely impressed by seeing this. This is since really the beginning of the year. And the internalization was done approximately in February. So this is even 1 month before the internalization. I would have started.
The majority of the changes had taken place at this stage. So
yes.
Okay, the majority. Okay, so it's fair. This is beginning of the year until now. So it's about 5 months, give or take. And you're comparing HYLD to the SPX index, which is not even another fund. It's literally SPX. And do I have this right that HYLD is currently outperforming the S&P 500? That's incredible.
when you use total return, including dividends,
Including dividends, of course, reinvested.
In this period, yes.
That's absolutely incredible. I'm kind of in shock by seeing this because I made a video saying the truth about covered call ETFs and how they will probably not outperform the index. But this is, it's 5 months time frame. Obviously, long term is a different story. We'll have to wait and see. But I still find it very, very impressive that you're right now in that 5 month period. You're beating the S&P 500. Either way, it's very, very close. What do you attribute this to as well? For HYLD.
Well, so the one thing I was going to say before I defer to Pat is one of the things we're happy about is that this strong relative performance, albeit in the shorter period, has taken place in a strong upmarket. Because
that's even more impressive.
Yeah,
right?
It's typically when you get the loss of, there's no question that options-based strategies underperform in rallies, all things being equal. So we've been very happy about this. Now, one of the challenges we have is some of the performance of HYLD since the internalization is attributed to funds that are less than a year old, and we're not able to talk about performance or yield in those funds. But if you look at some of the underlying holdings, most of them have not been around for a year. So we can't really talk about the performance, but you can yourself have a look and see how some of the underlying have done. And let's just say we're very happy.
Yeah. So if you look, for example, at SMAX, QMAX, some of the other ones in HYLD, these are strategies which generally will have about 30% coverage.
Yes.
If you recall, we replaced some other ETFs that had much higher coverage ratios.
Yeah.
So this allows us to capture more of the upside while still delivering a very healthy yield. So that's clearly working. And then obviously this is just another example of leverage working for you in up markets, right? When we launched HYLD, it was pretty soon after that we faced a down market, and so that the leverage would work in the other way. But over time, we think this should be a very good long-term hold for investors.
Yeah, that's why I think that
leverage
leverage
income is, if income is their focus, I'd say.
Yeah. Well, leverage, I'm sure plays a part, right? I mean, a little bit of leverage goes a long way. This is even when rates are fairly high. If rates start going down and down and down, which they're expected to, I don't want to make predictions. Will that even lower leverage costs even more for HYLD and HDIV?
Absolutely.
Well, it's even better.
No, yeah. So there's a lot of debate around the implications of higher financing costs in this product structure. But even at these rates levels, I mean, it's pretty clear that the modest leverage is still your friend. As long as you think the market's going to go up and you're a long-term investor and you're patient, then at this level, the leverage will work to your advantage. It will give you more volatility, no question, and more downside if there's a correction, no question. But if you have a long-term investment horizon, the leverage will work for you. And importantly, it will add incremental returns, it should, even at these interest rate levels, and the power of compounding,
Yeah.
the longer you hold, the more it's your friend.
This is why I'm excited to do these follow-ups. You know, hopefully in 5 years we could have this meeting and we'll see
Yes.
after 5 years. I think it'll keep getting exponentially better and better, especially if leverage costs go down. Like you said, with time, that compounding, that leverage is always going to be your friend long term. I agree with that.
As long as it's
100%.
modest, like I guess question, you know, it's a little bit of leverage.
Yeah, it's not a lot.
25%.
It's 25%. Yeah.
Yeah, and so we think we like that. We often say that's the Goldilocks amount of leverage. It's an amount that helps you, that matters.
Yeah.
But it's not so much that it really significantly changes the volatility or risk profile of the underlying.
Yeah, no, that's fantastic. And I think just the last thing I want to show people is I did a comparison myself. Let's see here, screen. So hopefully you could see this picture.
Yes.
Yeah, so I am comparing HYLD to VSP, which is literally the Vanguard S&P 500 Canadian hedge. We got to do the Canadian hedged one because HYLD is a Canadian hedged product, apples to apples. And I just did since the beginning of February. And this is basically corroborating what you guys have shown. HYLD is outperforming VFV by not a super significant margin, but by a little bit. You see 8.27% versus 9.56. But what's impressive to me is that this is during mostly an up market. I mean, that's what's extremely I'm in shock when I see this, because you know, down market, flat market, of course it's going to outperform, covered call strategies do, but during a mostly up market, it's absolutely it's incredible data. So congratulations on your success. I mean, I love this fund. It's a lot of my viewers and subscribers love this fund. Just for fun, because I want to see your reaction. I went back the other day and I calculated just my personal family members. So myself, my parents, my grandparents, my sisters, aunt and uncle. Collectively, we have over $1 million in HYLD.
Well, that's a
And everyone's very happy. No one's complained about anything. And you know, older Italian people complain a lot. Nobody ever complained about HYLD, I'll tell you that much. So we want to say thank you.
Yeah, thank you.
I think just ending where we started, taking all of the funds internal and taking full control over the funds, and being able to put in funds that were designed by Babak Asadi and Nick Picard. They've done a phenomenal job designing what we think are some very good yield maximizer ETFs. And we believe that our unit holders will benefit from what we think is some very good product design.
Yeah, I completely agree. I mean, it's definitely working. Definitely working. I mean, you know, beating the TSX 60. You know, I think my grandmother's duplex could beat the TSX 60. But the S&P 500 is a different story, and I think the performance is absolutely incredible. So I don't want to keep you guys. I mean, you guys are good sports. You're taking the time, Rob. I know you're busy with the bank earnings and all that stuff, but just lastly, I don't know if you guys saw this. I was just curious for your reaction here. Have you seen this article where it says a military, you know, a retired military guy? He basically got very, very lucky in his TFSA. He chose the Shopify stock. He bought at the right time. It blew up. He sold it at the right time. And then he invested pretty much the majority into covered call ETFs. And now he's making $11,000 a month of tax-free income. And, you know, I made a video. It's already out. It came out yesterday about it. I'm trying to get this guy on the channel. But what I really liked was this one here. He learned about using these products, which employ a strategy of selling call options, by watching YouTube videos. So hopefully it's my videos. I would absolutely love that. And
I would bet that it is.
I would bet that it is also, because I don't know how when he started, but it says he's making 14% yield. So I'm assuming he bought them a year or two ago. So it matches up. It matches up, but it says that most of the exposure is in broad exposure to S&P 500 and Nasdaq. So I have a strong suspicion he holds a lot of HYLD. What's your reaction to this kind of article, or when you
Yeah,
see something like
I
this?
don't want to speak for the individual client, but when I read it, when you forwarded it to me, and I wanted to mention this at the beginning, like I think you should be commended for the work you're doing. Like you're doing a lot of work educating
Absolutely.
people
I
on
appreciate
a
that.
category that's growing a lot, and you're helping them make decisions, right? Like you're giving them the information they need to help them with those decisions. Because there's so many different strategies to choose from, and you're becoming or are the go-to place to get that information. So I think it's great. That's my takeaway from the article personally.
Yeah, I mean, I like if you read the article, you see that this guy he has a plan every step of the way, and everything started going well when he took matters into his own hands, started investigating these funds, and at one point he was in his TFSA was with just cash savings account.
Right.
And then he switched to dividend stocks, and then so I like the fact that, people are learning about this style of investing, and it's a great style for people who need income. His
Yeah.
wife was about to retire or something like that, and we needed to replace their income. So, I feel like it's very important to figure out what your goal is, your objective is, and finding the right investment solution. So
But
I
also
just thought
what
that
you're
was cool.
saying is very balanced. You're giving people a balanced education on these products.
Yes.
The pros, the cons, who they're for, which I think is really important.
Yeah, yeah.
Yeah, I
Well,
mean, when it comes to covered call ETFs, I mean, there is a yield return trade-off, and some people are very comfortable making that trade-off because they prioritize income
yeah,
over total return, and that's because it suits their own individual needs. And then there are people who prioritize total return over income, and therefore they don't really like covered calls, and that's fine too, because that's their priorities and that's unique to them. And so I think it's always important, for people who own covered calls, their priority is income, and we have an
yeah.
income first approach. And so our products are designed for them. We have other products designed for those who prioritize total return. But it doesn't mean that the people who own covered calls, are somehow misguided or don't understand what they're doing, which is a lot of the total return critics of covered calls. It just means they have a different,
Yeah.
for them, they have a different set of objectives that is for them. Maybe they need to live off of that income. Maybe they're at a stage of their life where they need that income and they're prepared to forego some upside. Maybe their time horizon is different. But sometimes it's unfortunate that maybe some of the total return people are maybe a little less understanding of the fact that their personal circumstances and objectives are very
Exactly.
different from those who own covered calls. And it doesn't mean that the people who own covered calls, are somehow missing that main point. It's that they have different priorities.
Yeah, well, you put it very, very, very nicely, more nicely than I would, Rob. But
But
basically, if I take, I've been doing this over 4 years now, I believe. If I take all the criticism, all the negativity around covered call ETFs, it all boils, whether it's high fees and stock charts and NAV and all the things you could just put it all in one category, total return. Right. And like you said, there is a yield return trade-off, but look at HYLD, how it's doing to compared to the VSP, compared to the S&P 500. It's beating it right now. And let's say it doesn't beat it long term. It's fairly close. So it's not that you're giving up an astronomical amount of total return. That's why I love the leverage ones as well. I
yeah,
think it
and,
really
and that's the
helps.
goal. And that's always been the goal of the modest leverage, which is to ameliorate the yield return
Yeah,
trade-off. It's not likely to eliminate it. It's
I
not likely to
agree.
eliminate it, but
It
as long as
helps.
it makes it more competitive, then I think we would be very happy.
Yeah. Exactly. So, guys, it's always a pleasure speaking with you.
Thank you.
It's great
Yeah,
that
thank
you
you for
took the
having us.
time.
Hopefully we'll see some of your followers at the Blossom social event. We'll be there in Toronto.
Yeah. Oh, that's awesome. Yeah, I won't be in the Canada ones this year because I'm actually in New York. I'll be for another event, but since the Blossom event, the first one in the U.S. in New York is going to be there, I'm going to be at the New York Blossom event.
Uh,
That's going to be really, really fun. So it's going to be cool. I'll go to New York. I'm going to take a picture next to the bull. Uh, I might
that would be
even, I think I'm getting a tour of the New York Stock Exchange. So there's a pretty cool event I'm going at. yeah, so it's going to be fun. So I won't be at the Toronto, Montreal ones, but maybe next year I will be. So have fun, guys. I'm sure you'll meet a lot of people who love the Hamilton products, and we'll have you back, of course, in the future for sure.
That would be
Okay.
great.
Appreciate it, Adriano. Thank you.
Have a good one, guys. Take care.
You too.